Imagine two people. One buys a Rolex to look successful. The other builds a Rolodex full of powerful contacts. 10 years later, the Rolex lost value, but the Rolodex produced millions. So here's the rule. Never buy a Rolex until your Rolodex pays for it, because the most connected person in the room almost always out-earns the smartest one. I'm going to show you why, and more importantly, how to become that person. Let me show you how powerful networks really are. Two engineers graduate from the same university. Same grades, same intelligence, same technical skills. 5 years later, one is earning $80,000 a year. The other is earning $500,000. Did one suddenly become 5 times smarter? No. One focused on polishing resumes. The other focused on building relationships. And relationships compound faster than skills. Most people believe success is about credentials. Better resume, better degree, better technical skills. But the majority of life-changing opportunities don't sit on job boards. They sit in conversations, in introductions, in proximity. Today, I'm going to show you why the most connected person in the room almost always out-earns the smartest one, and exactly how to become that person. We're covering asset allocation, portfolio diversification, and loss aversion. Not just as financial concepts, but as psychological ones, because wealth isn't just numbers, it's social leverage. And once you see it, you can't unsee it. Let me ask you something simple. If most critical career opportunities are filled through networking, why are most people still polishing resumes instead of relationships? The majority of life-changing opportunities don't sit on job boards. They sit in conversations, in introductions, in proximity. When economists studied professional networks, they found something measurable. Strong networks reduced job search time, increased wage offers, accelerated long-term salary growth. That's not motivational advice. That's economic impact. And yet, most people invest more energy into looking impressive than into becoming connected. They'll finance the Rolex before they finance access. Let's talk about what wealthy people do differently, like social asset allocation, which, in finance, asset allocation means dividing capital across categories: stocks, bonds, alternatives, cash. The goal? Balance risk and growth. Now imagine applying asset allocation to proximity. Instead of allocating money, you allocate exposure. High performers diversify their social portfolio intentionally into mentors for stability, ambitious peers for growth pressure, industry insiders for information flow, connectors for distribution power. That's portfolio diversification. Socially, if everyone in your circle earns the same, thinks the same, fears the same risks, your opportunity pipeline is fragile. But if one contact is in private equity, one in tech, one in media, one in policy, your optionality multiplies. That's social wealth management. And here's the part nobody says out loud. If you are socially invisible, you are economically limited. Let me tell you about Marcus, who is a founder. He has a solid revenue, strong retention, clean balance sheet. But investors weren't engaging. He kept asking, "Is it my numbers?" But it wasn't. It was his network density. Buyers don't just acquire companies, they acquire trust. Two identical businesses can sell at completely different valuations. Why? Because one founder is known, referred, and socially validated. Trust reduces friction, and friction costs money. Marcus stopped cold pitching investors. Instead, he started hosting small private dinners. Few people, curated rooms, operators, capital allocators, strategic advisors. No pitching, just proximity. Within 6 months, 2 attendees introduced him to acquisition interest. The deal closed above industry average multiple, not because his numbers changed overnight, but because familiarity lowered perceived risk. That's the network premium. You don't scale wealth first, you scale access first. Wealth follows access. In 60 seconds, I'll show you the psychological glitch that's been quietly deleting your opportunities and why intelligent people are the most vulnerable to it. If networking is this powerful, Why don't more intelligent people do it? Because of the spotlight effect. Psychologists discovered something fascinating. Participants wore embarrassing t-shirts into a room. They predicted about 50% of people noticed. In reality, less than 20% did. Your brain exaggerates visibility. Now, fast forward. You open LinkedIn, draft a message, delete it. What if they ignore me? You record a video, hesitate. What if it looks awkward? You want to post. You almost do. Then you don't. Because your nervous system interprets visibility as risk. But here's the reality. Everyone else is thinking about themselves, checking their own portfolio, managing their own stress. You are not the center of their day. But your brain doesn't know that. And that's where loss aversion enters. Loss aversion means losses hurt about twice as much as gains feel good. Here's what most people miss. Your brain treats social rejection exactly like financial loss. When you send a message and get ignored, post and get low engagement, pitch and get rejected, your brain says, "Loss detected." So you stop. You retreat. You protect your ego. And that delay compounds, just like money compounds, except this is reverse compounding, opportunity decay. Let's talk about the March 2020 parallel. When COVID hit, markets dropped 34% in 33 days. Millions of retail investors panic sold near the bottom, not because the math changed, but because fear spiked. The emotional pain of watching red numbers every morning triggered loss aversion. They sold at maximum discomfort. Markets recovered fully within months, then ran to all-time highs. Those who stayed disciplined didn't just recover, they multiplied. You post once, low engagement. You stop. You reach out once, no reply. You retreat. You pitch once, rejection. You shrink. That's selling at the bottom of your own visibility cycle. Compounding rewards endurance, but endurance requires psychological regulation. That's the invisible edge. Here's another layer. Opportunities don't move evenly. They move through networks. This creates information asymmetry. High-level investors hear about private deals, strategic hires, board seats, and emerging trends months before they go public. Why? Because information travels through relationships faster than through media. If your network is limited, your information flow is delayed. Delayed information equals delayed opportunity. You can't participate in what you don't know exists. Upgrade your information environment. Upgrade your proximity. Proximity is a choice. Let's make this operational. First, curated networking. Stop random events. Instead, do what Marcus did. Design your rooms. Identify 3 adjacent industries. Build one meaningful connection in each. Maintain weak ties intentionally. Weak ties bring new information. Strong ties reinforce old information. Diversify accordingly. Second, automate against loss aversion. Wealthy investors automate rebalancing because discipline beats emotion. Apply the same logic socially. Reach out to 2 new people weekly. Follow up twice before assuming rejection. Post consistently regardless of engagement. Rules bypass ego. Rules reduce loss aversion. Rules scale confidence. Third, emotional portfolio diversification. If all your validation comes from one platform, you become fragile. If all opportunity comes from one client, you become exposed. Diversify income streams. Diversify exposure. Diversify risk. Emotional stability increases financial stability. There's one final shift that separates the 1%, and it has nothing to do with income, intelligence, or strategy. It has to do with identity, and most people never update it. You can learn finance, you can understand markets, but if you still see yourself as someone who might be judged, you will underperform your potential. Most people operate with inherited identity. I'm not the networking type. I'm private. I don't want attention. That sounds humble, but often it's fear wearing the mask of personality. High performers audit identity like portfolios. Is this belief appreciating or depreciating? If your identity reduces opportunity exposure, it's a liability. The 1% don't wait for confidence. They adopt behavior first. Identity catches up. You don't become confident and then visible. You become visible, then confident. Different sequence, different life. The wealthy don't chase opportunity. They increase exposure until opportunity chases them. Visibility creates opportunity. Opportunity increases deal flow. Deal flow increases wealth. And none of that requires a Rolex. It requires courage. Here's what's at stake. Every week you stay invisible is a week your opportunity pipeline runs dry. Every pitch you don't send is a deal that goes to someone less qualified but more visible. The cost of inaction isn't zero. It compounds silently, in the wrong direction. So wealth is not just capital allocation. It's attention allocation, energy allocation, courage allocation. The Rolex is a symbol. The Rolodex is infrastructure. Infrastructure produces cash flow. Symbols consume it. If you understand asset allocation but not social allocation, you plateau. If you understand portfolio diversification but not relationship diversification, you stagnate. If you understand loss aversion financially but not psychologically, you self-sabotage. Stop performing wealth. Start engineering exposure. Start engineering proximity. Start engineering optionality. Because optionality compounds, and compounding rewards endurance. Never buy the Rolex until your Rolodex pays for it. I'm Vera, and don't forget to subscribe. I'll see you in the next deep dive.